In order for you to get rich by 2030, you definitely need to figure out how to become a better investor. And so in this video, I'm going to give you 9 tips to get you there. But first you have to be able to understand, what does it even mean to be rich? To me, it means that you would have enough in investments or saved up that you actually have options. You don't have to make a certain amount of money from a job or from your work or whatever in order to just basically live. And so my goal for you is to be able to get you to a point where you have enough in investments or saved up that you get to make the choice and you get to live how you want to live. So number 1 on this list is to have a goal or set many goals. Most of the time when I talk with people and I say, okay, cool, you're investing, what's your number? What do you want to get to? Most people are like, well, I don't know, I just want to have a lot of money. But what is even a lot of money? Like, where are you shooting for? A really good one for most people is at least a retirement number. One of the best ways to be able to do this is figure out, okay, how much money do you need per year just to live on with living expenses and maybe a couple of wants so that you're living comfortably. Whatever that yearly expense is, just multiply that by 25 and that gives you a retirement goal. So let's say you need $40,000 to live off of. 40,000 times 25 equals $1 million. So when you hit 1 million in investments, you should be able to retire off that number. So that's just one type of number, one type of goal to shoot for. But whatever your goals are, write them down so that you see them. And even better than that would be to talk to at least one person that you trust that can keep you accountable to actually go hit that goal. Number 2 on this list, you need a higher savings rate. Get serious with yourself here. You need to stop spending all of your money. If you make $5,000 per month and you spend $5,000 per month, you're never gonna grow. How can we get your spending down to $4,800 or even better down to $4,000? Yes, cutting out that Starbucks or Netflix subscription will help, but not really. I'm talking about big moves here. If you live alone, go find a roommate and they can pay half of your living expenses there. If you have a nice new car or an expensive car with an expensive payment, maybe downgrade to a used car with no payment or very little of a payment. $200 invested each month in the S&P 500 that returns an average of 10% per year for 25 years comes out to about $236,032. Finding an extra $200 each month, so now you're investing $400 each month in the S&P 500 that returns an average of 10% per year for 25 years comes out to about $472,065. If though you have $1,000 that you can now invest each month in the S&P 500 that returns an average of 10% per year for 25 years, that'll come out to about $1,180,164. Finding that extra $800 to invest each month comes out to an almost extra $1 million by retirement. That's the type of thing that changes your life financially forever. Number 3, huge tip here, watch out for fees. I made this channel so that this would empower you to go out and do this on your own. Financial advisors and money managers absolutely hate that I give away all this information for free because they want to charge you for it. They also want to confuse you and make it so that you feel like you can't do it on your own, so you'll always pay them that 1% fee for the rest of your life. I'm here to make it so that you don't have to pay that forever because it adds up huge. If a young investor bought into a broad US large cap fund with a starting balance of $10,000 and then contributed $100 a month over a 45-year career, it would end up being worth approximately $1.6 million before fees, assuming the historical rate of return held over the entire period. Now let's assume the model portfolio charges an annual fee equal to 1% of its value. Seems like a very small amount, right? But over the course of 45 years, this seemingly insignificant fee would consume almost 1/3 of the final portfolio balance. It would be worth around $1.1 million, fees having cost approximately $480,000 in total. If the portfolio had only charged a 0.50% fee, the final value would be $1.3 million, with fees consuming $216,000 over the life of the investment. Those little 1% fees really add up. You can absolutely do this yourself by following my simple 3-fund portfolio that I talk about all the time on this channel. Number 4, there's no way around it. In order to be a better investor and to make your investments actually work harder for you and grow to the point that is actually going to be life-changing, you need to be making more money. Looking for a higher paying job or starting a side hustle or business idea are some of my favorite ways to do this. In order to make yourself more valuable, you need to learn new skills that are in high demand. AI is completely restructuring the economy and transforming the value proposition of human work. AI skills aren't just a trend anymore, they're a necessity. You must effectively learn how to use these new AI tools. That's why I'm super excited to share with you OutSkill's 2-day AI Mastermind, and thank you to them for sponsoring this video. It's the world's first AI-focused education platform which is backed by renowned AI investors and AI founders. This 2-day program offers 16 hours of live AI training spread across 2 days. This is a paid training valued at $895, but exclusively for my audience, you can attend it completely free. You can find the link down in the description. Now in this program, you're going to gain in-depth knowledge on a wide range of topics, including 20+ AI tools to build AI toolkit, prompt engineering to achieve incredible results, data analysis without coding, using AI in Excel and creating professional presentations effortlessly, and automating your work to save time and boost productivity. And that's just the beginning. Professionals from tech and non-tech sectors like sales, marketing, HR operations, and even business owners and freelancers had attended and loved it. This training is for everyone, but slots are filling up faster than ever. Click the link in the description to book your slot. Make sure to join their WhatsApp groups to get all of the updates. And remember, the introduction call starts on Friday at 10 a.m. Eastern. All right, so now on to number 5. You have to be relentlessly consistent. From before, we talked about making sure you have a higher savings rate, and just now we talked about making more money. Doing both of those is going to be great, but the missing key for most people to be actually successful in investing is that they miss that consistency. Specifically making sure that you have a set schedule as to when you're investing. Some of you have probably heard it as pay yourself first. What this basically means is that when you invest, you're basically paying yourself down the road. You're making it so that you have a better financial future then. So make sure that that's high on the priority list. The best way to do this is to automate this. Some of you already have that within your 401k because it's taking the money out of your paycheck and putting it in the 401k every month. But we want to increase that. We want to get that into a taxable brokerage or a Roth IRA or whatever else you'd like to do to invest, but make it consistent. Number 6. Okay, so how to invest, especially in 2025. One huge thing here is that you need to become an investor and not a speculator. You can't just watch a couple of these videos or read 1 or 2 blogs and just say, okay, well, they said this stock is cool and yeah, it sounds like a pretty good one, so I'm just gonna buy it. If you don't know very much about it, all you're doing is speculating. You're thinking like, okay, it's probably gonna go up. But what if it goes down? What if, like in 2025, how most things have dropped 15–20%, is that gonna scare you out of the stock? Because if all you bought it for was because you thought it might go up and then it goes down, unfortunately, that's the extent of what most people do as research for their stock investing, and then they get spooked out of something because it dropped, and then they sell, and now they for sure lost money. You need to look at things, instead of looking at it from short term, you need to look at long-term investments. One of the things that I really like about Warren Buffett, he says that if you can't see yourself owning a business for 5 years, then don't even think about it for 5 seconds. And I agree with that. When I look at investing in a company, I'm looking at it as if I'm holding this company for the next 5, 10, 15, 20 years, not just until it goes up. I know for a fact that if a business is even around 10 years from now, it will have had to go up because a business can't just stay put and definitely won't go down in order to stay alive 10 years from now. So you have to look at investing in the true sense of the word. If you were an angel investor in a small company, you'd be putting money into this company that makes little or no money now, but hopefully with your capital, they can put it to work and they can have new systems and hire new people and make better technology or whatever, and that should make the business grow, which should make the profit grow, which should make you more rich as an investor. Same thing when we're investing in large companies like Apple or Microsoft or whatever. You do need to remember that past performance is not an indication of the future. It's not necessarily guaranteed to do the same thing that it did in the past. But to all the haters out there that always say past performance doesn't mean future, that's true, but looking at the past is still important. Looking at history, seeing how it fared during historical events is very important, and it gives us data for what might happen in the future. So do a bunch of research and become an investor and not a speculator. Number 7, tune out the noise. Every year there's something new that's supposed to tank the market so bad that the stock market will never recover. And every year we get past it. There are moments in time when the stock market drops crazy. Like now in 2025, it's down 15 or so percent. But understanding that it will come back and keep thriving is very, very important. I like to look at the S&P 500 chart for as far back as I can. Yes, there are dips and drops in there, but overall it's up and to the right. We have withstood Great Depressions and recessions and global financial crises. Those are all far worse than what we're seeing right now, so just stay the course and everything's gonna be okay. Number 8. Actually, these last two are specifically what to invest in. For this one and tip number 9, you need to figure out your risk profile. So you need to understand, are you somebody who likes to take more risks, or would you like to be a little bit more safe, or are you kind of in the middle? This is very important to figure this out before you start investing, or at least before you start investing heavy. Then understand what each investment category is within your investing. So I'm going to kind of list it out from the most conservative or safe all the way to the most risky. So cash and cash equivalents, like maybe bonds, that would be considered ultra conservative. Then you have like a dividend ETF, that one's going to be safe. Then you have like the broad market ETF, something like the S&P 500 or total US stock market, and that's your foundational or neutral, right in the middle. Then you have a growth ETF like QQQ or something of that nature, and that would be a bit more risky. Then on the far right would be cryptocurrency or hyper-growth individual stocks, and those might be a little bit more extra risky. If right now you're freaking out a little bit because your whole portfolio has dropped like 60%, you probably have too much in those far right categories, and you might need to move a little bit of it over to the left to make sure everything balances out a bit. Number 9, specifically what to invest in. 90% of professional traders can't beat the S&P 500. There's people working on this 12 hours a day, and they still can't beat a basic index fund with a very low fee. Warren Buffett famously made this bet that basically a monkey could pick any of the companies within the S&P 500 and beat a fund manager that's picking different companies that whatever their model would pick, and with their fee, the monkey would win. And guess what? The monkeys did win, and they consistently win. And it really has to do with a couple of factors, one of them being the fees that I talked about from before. It's just so hard to beat the S&P 500 or total US stock market over any long period of time. Index funds and ETFs are where you want to be. I encourage my clients to be 80 to 90% ETFs, 10% individual stocks, and then 10% cash or cash equivalents based on their short-term needs. In this video, I go over that simple 3-fund portfolio, and it's such a simple strategy that you can follow and totally do on your own, save yourself so much money in fees, and make that portfolio grow like crazy. Or watch this video to keep you going strong in your investing journey.